Hey, good morning once again, options traders. Well, I got a really good email from one of the traders in our group saying that he was starting to do a lot of day trading with these zero DTE options and selling them, which I don't think is a really good idea for a number of reasons. We can talk about that in a future video, but his rationale was because we're on such a steep part of the time decay curve, it doesn't look like a normal time decay curve. Because if you look at a time decay curve, when you get into the final 30 days or a couple of weeks, you start going almost vertical. And he said, because you're just going off such a steep part of the time decay curve, you've got this really big advantage. Well, possibly, at least in terms of theta. Gamma and vega are another story. But the question that he was posing here, or his rationale, is really where the problem lies. What he's really talking about is the shape of the time decay curve. And does a short-term time decay curve really look any different from a longer term? Well, good question. Let's go check it out. What does an hourly time decay curve look like? And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So the first thing to remember that when you're dealing with options, we are always involved with this square root pricing principle, which we've talked about many times in different videos. So option prices are proportional to the square root of time. It's not like an interest rate, where if you have a 5% annual rate, that in 6 months you're earning 2.5%, that you can just scale it out according to time, scale it out proportionally. Well, you can't quite do it that easily with options. You have to go by the square root of time. And the reason for this is that option prices are proportional to volatility, and volatility is proportional to the square root of time, and therefore option prices are proportional to the square root of time. I know it sounds complicated, but it's really important to understand before you start making mistakes like this about selling zero DTE options because you think you're on a very different time decay curve that's just going up and down. So let's look at what we might call a standard time decay curve. Now remember, this time decay curve that we see in all of the books and the websites applies only for an at the money option, or more of a near the money, something that's very close to at the money. And on this graph, we've got 120 days until expiration, and over here is 0 days, so we have time moving from left to right towards expiration. So the option looks like it's trading for somewhere close to 7, and the principle that you need to understand is that when 75% of the time has passed, in other words, from 120 days until expiration down to 30 days, that option is going to lose half of its value. So it was trading for about 7, and at this point it will be trading for half the amount, or about 350. But take a look at what that implies. The remaining 25% of the time also will lose 50% of that option's value. So that's where traders get this idea that you're really going off the steep part of the time decay curve in the final 25% of the time. So a trader might say, okay, I'm going to buy this 120-day option, but I'm going to bail out when there's 30 days remaining because I want to avoid this very steep part of the time decay curve. And they're just looking at the general shape. They're saying you can see up in this zone, it's relatively flat. And then as we get closer to expiration, we start getting a little bit steeper. But take a look at this, especially when we're trading a zero DTE, an option that expires that same day. And it looks like you're going almost vertically. So in their minds, their time decay curve, this one in blue, looks more like this red arrow, that it's just this vertical line. Well, that's just simply not true. All you've done is rescaled the time. So if we look at a zero DTE time decay curve, look at that. Looks exactly the same. But now we're just going to scale it according to minutes. So there's 6.5 hours in the trading day, at least in a standard trading day, not assuming there's a partial day for holidays and stuff like that, but we've got 390 minutes in a 6.5 hour day. So if we go from 390 minutes down to 0, we get exactly the same shape. So now you can see this one-day option's worth about 33 cents with 390 minutes to go. So when 75% of the time has passed, that option will have lost half of its value. It'll be trading for about 16 and a half, 17 cents right in here. And that means for the final 25% of the option's life that it's going to also lose 50% of its value. So at what point are we when 75% of the day has passed for the trading day? It's going to be about 2:22 p.m. And this is why you will hear a lot of traders who do day trading will usually give themselves this arbitrary cutoff point of about 2:30 p.m. because you are now on the relatively steep part of the time decay curve. So the thing to notice is that we haven't changed a single thing about the shape of the curve. There's always going to be a 25% mark. We're just changing the numbers across the bottom. So no, it's not like your time decay curve is just straight up and down. It still has this square root shape to it. So to understand why this happens a little bit better, let's jump over to an Excel spreadsheet. So now we're into an Excel spreadsheet, and I've just got some numbers going from 0 to 20. And in Excel, if we want it to take the square root, I'm just going to take equals SQRT, parentheses, we're going to point to this number. I'm going to close up the parentheses, and there we go. Square root of 0 is 0. I'm just going to drag this formula down, and what it's going to do is just take the square root of the number to the left of it. And here is the graph. Looks just like a time decay graph. See, that's why all of your time decay graphs really look exactly the same. Doesn't really matter what your scale is down here. These aren't even option prices, and we get exactly the same time decay graph. Now you might be thinking, well, wait a minute, how come your graph went in the opposite direction? Well, that's just more of a matter of style. Mathematically, this is really the correct way to draw a time decay graph because 0 is here to the left, and we count up, going from 0 to 20. But conceptually, it's usually easier to think of time as moving from left to right. And so it's more of a style thing, where some books and websites will say, let's put the 20th day in this example out here and 0 down here. So all I have to do in Excel is I can format the axis and I can flip the categories in reverse order, and there we go. There's your time decay graph, and you will always get this regardless of the numbers that you put over here. So what does that tell you? It doesn't matter which time frame you're in. You could be in a weekly time frame, hourly time frame, minutes, seconds. You could look at leaps options. It just doesn't matter. You're going to get exactly the same shaped time decay curve. So one of the main points of this is that you shouldn't go out and sell 0 DTE options because you think that you're on some kind of a special time decay graph that is straight up and down. You're on exactly the same risk graph, just in a different scale. So the question shouldn't be, did I somehow get a better time decay curve? The question is, do I have an edge in my trade? And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.